Hello everyone. Today we're going to be talking about financial ratios. This presentation covers many areas related to financial overview. It's going to be really fun. So let's get started. What is a ratio? A ratio is a way to show a relationship or compare two numbers of the same kind. We use ratios to compare things of the same type. There are four types of ratios: liquidity ratios, leverage ratios, activity ratios, and profitability ratios. So let's understand what is a liquidity ratio. Financial measurements called liquidity ratios assesses a company's capacity to pay off both short and long-term debt. The following list of typical liquidity ratios include current ratio, quick ratio, and cash ratio. Current ratio. The easiest liquidity ratio to calculate and understand is the current ratio. In a company's balance sheet, the line items for current assets and current liabilities are simple to locate. The current ratio is calculated by dividing current assets by current liabilities. Quick ratio. The quick ratio is a harsher liquidity test. Both have the same denominator and numerator, which are current assets and current liabilities. However, it only takes some current assets into account. Cash, accounts receivable, and marketable securities are among the most liquid assets taken into account. The formula of quick ratio is equals to cash plus account receivables plus marketable securities upon current liabilities. Third we have is cash ratio. The measure of liquidity is furthered by the cash ratio. This ratio solely takes a company's cash and marketable securities into account, which are its most liquid assets. These are the resources that a business can use to fulfill short term commitments the quickest. You can think of a current ratio, quick ratio, and cash ratio as easy, medium, and hard assessments of liquidity, respectively. Cash ratio is equals to cash plus marketable securities upon current liabilities. Now, let's understand what is a leverage ratio. A leverage ratio is any kind of financial ratio that indicates the level of debt incurred by a business entity against several other accounts in its balance sheet, income statement, or cash flow statement. Debt to equity ratio. It comes under leverage ratio and it is one of the most used measures of debt solvency. The D by E ratio is another way to display it. Divide the total liabilities of a corporation by the equity held by shareholders to determine the debt to equity ratio. The balance sheet of a company's financial statements is where these values are found. It is a crucial statistics that is employed to assess the financial leverage of a corporation. Debt to equity ratio is equals to long term debt divided by shareholders' funds, or debt to equity ratio is equals to total liabilities divided by shareholders' equity. Next is debt ratio. The debt ratio is a financial statistic that is used to assess the financial leverage of an organization. It is determined by dividing the total liabilities by total capital. The riskier the company is, the bigger the debt ratio. Bank loans, bonds due, notes due, and other long term obligations are among them. Debt ratio is equals to long term debt divided by capital, or debt ratio is equals to long term debt divided by net assets. Next, we have is proprietary ratio. Proprietary ratio is also known as equity ratio. It provides a connection between the capital or net assets and the proprietor's finances. Equity ratio or proprietary ratio is equals to shareholders' funds divided by capital, or shareholders' funds divided by total assets. Next is interest coverage ratio. The company's ability to pay interest on the outstanding debt commitments is assessed using the interest coverage ratio. It is computed by subtracting the interest payment due on debts for the accounting period from the company's EBIT, that is, earnings before interest and taxes. A higher coverage ratio is better for the solvency of the business, while a lower coverage ratio indicates debt burden on the business. Interest coverage ratio is equals to EBIT divided by interest on long-term debt, where EBIT stands for earnings before interest and taxes or net profit before interest and tax.
Activity ratio or efficiency ratio. The efficiency ratio is typically used to analyze how well a company uses its assets and liabilities internally. An efficiency ratio can calculate the turnover of receivables, the repayment of liabilities, the quantity and usage of equity, and the general use of inventory and machinery. This ratio can also be used to track and analyze the performance of commercial and investment banks. So, what does an efficiency ratio tell you? Efficiency ratios, also known as activity ratios, are used by analysts to measure the performance of a company's short term or current performance. All these ratios use numbers in a company's current assets or current liabilities, quantifying the operations of the business. An efficiency ratio measures the company's ability to use its assets to generate income. For example, an efficiency ratio often looks at various aspects of the company, such as the time it takes to collect cash from customers or the amount of time it takes to convert inventory to cash. This makes efficiency ratios important because an improvement in the efficiency ratios usually translates to improved profitability. The common efficiency ratios include: first, asset turnover ratio; second, inventory turnover ratio; third, receivable turnover ratio; fourth, day sales in inventory ratio. The asset turnover ratio measures how a company's ability to generate sales from asset. The formula of asset turnover ratio is net sales upon average total sales. The inventory turnover ratio measures how many times a company's inventory is sold and replaced over a given period. The formula is inventory turnover ratio is equal to cost of goods sold upon average inventory. The accounts receivable turnover ratio measures how many times a company can turn receivables into cash over a given period of time. Formula is receivable turnover ratio is equal to net credit sales upon average account receivable. The day sales in inventory ratio measures the average number of days that a company holds on to inventory before selling to its customer. Day sales in inventory ratio formula is 365 days upon inventory turnover ratio. What are profitability ratios? Profitability ratios are a class of financial metrics that are used to assess a business ability to generate earning relative to its revenue, operating costs, balance sheet, assets, or shareholders' equity over time using data from a specific point of time. Profitability ratios can be compared with efficiency ratios, which consider how well a company uses its assets internally to generate income. They assess a company's ability to earn profits from its sale or operations, balance sheet assets, or shareholders' equity. Profitability ratios indicate how efficiently a company generates profit and value for its shareholders. Higher ratio results are often more favorable, but these ratios provide much more information when compared to results of similar companies, the company's own historical performance, or the industry average. The types of profitability ratio are: the first one is gross profit ratio. So, it is a profitability ratio that assesses the relationship between the gross profit and net sales revenue. It is also referred to as the gross profit margin when it is expressed as a percentage. A changing gross profit ratio is a sign of subpar management or product quality. The formula of gross profit ratio is gross profit upon net revenue of operations into 100. Second type of profitability ratio is operating ratio. Operating ratio is calculated to determine the operation in relation to revenue earned from its operations. Third is operating profit ratio. It is a type of profitability ratio that is used to determine the operating profit and net revenue generated from the operation. It is expressed as a percentage. Fourth is net profit ratio. It is a crucial indicator of profitability despite the connection between net sales and net profit after tax. It is referred as the net profit margin when it is expressed as a percentage. It aids investors in determining whether the management of the company is able to turn a profit from sales and how efficiently operating costs and overhead costs are controlled. Fifth is return on capital employed or return on investment ROI. It is a profitability ratio that measures how well a company is able to generate profits from its capital. It is an important ratio that is mostly used by investors while screening for its company to invest. Sixth is return on net worth. This ratio sometimes is referred to as return on shareholders fund and is used to assess whether or not shareholder investments may produce lucrative returns. It must also exceed the return on investment, as doing so could mean that the company's funds are not being used efficiently. Seventh is earning per share EPS. It is a profitability ratio that measures the extent to which a company earns profit. It is calculated by dividing the net profit earned by outstanding shares. Eighth type of ratio is book value per share. It is referred to as the equity that is available to the common shareholders divided by the number of outstanding shares. Ninth one is payout ratio. Payout ratio is the dividend payout ratio that calculates the amount paid to shareholders as dividend in relation to the amount of net income generated by the business. Tenth is the price earning ratio. It is often referred to as the PE ratio. It establishes a connection between a company's stock price and its earning per share. It is very beneficial for investors because they are more interested in learning how profitability of the company shares are now and how profitability they will have in the future.